In this week's market update, the Fed shines a light on its policy U-turn, the EU decides no deal or flextension, India kicks off the world's biggest election, and first quarter earnings season gets underway. The Federal Reserve will this week provide some clarity on the market's biggest question: what lies behind the US central bank's dramatic policy U-turn last month? The Fed gave investors a positive shock in March when it put on pause its plans to keep raising interest rates while cutting back on the $4 trillion or so of bonds sitting on its balance sheet. Everyone had expected a modest easing of policy, but the scale of the change in direction was surprising. Markets are unsure what to read into the new dovishness in Washington. Stock markets enjoyed the strongest start to the year for many years as investors responded to lower than expected interest rates in their usual fashion. But bonds have also been in favour as other investors worried that the Fed might know something bad about the US economy that the rest of us do not. It's quite unusual for shares and bonds to both rise at the same time, and it's likely that one set of investors is wrong. Wednesday's publication of minutes from the March Fed meeting will therefore be scrutinised by investors for guidance on the central bank's thinking. As it stands, US interest rates are expected to remain at between 2.25% and 2.5% for the rest of the year. That's a marked slowdown from the 4 rate increases the Fed enacted in 2018. But even this might understate the Fed's dovishness. According to the financial futures markets, the next move later this year might actually be down, with the chance of a cut this year now estimated at around 60%. To counter that view, the Fed would have to reassure investors that it's confident about the health of the economy. Central bank activity on this side of the Atlantic will be less interesting. The ECB will unveil its latest policy decision on Thursday, but no one is expecting much. After announcing new low-cost loans for banks in March, the ECB is likely to hold fire with any further policy moves until June at least. The main concern in Europe this week is not interest rates, of course, but the latest developments in the Brexit saga. Friday is technically the day on which, in the absence of an agreed withdrawal deal, Britain will crash out of the EU. In practice, no one is seriously expecting this outcome, as the damage from a no-deal Brexit on both sides of the English Channel will be too great to allow. Theresa May has already written to the EU requesting a short extension until the end of June and promised that Britain will take part in European Parliament elections in May if we remain in the bloc on the 23rd of that month, when the votes are due to take place. Probably more likely than another short extension is a longer-term pause to give Britain the chance to finally decide on a course of action that can get passed by MPs. One proposal is a long extension of up to a year with an effective break clause if we do agree a deal. This is the so-called flextension approach. Not everyone agrees that this is the best way forward, however, with the French government under Emmanuel Macron most vocal in suggesting that the EU should call Britain's bluff and allow us to drive over the no-deal cliff edge. We'll find out more on Wednesday. In the meantime, markets are increasingly unsure how to trade the Brexit situation. On the face of it, UK shares represent a fantastic contrarian opportunity, but many international investors are sticking to the view that they can safely ignore the London market. Representing just 6% of the total value of global shares, the UK is not make or break for a global investor. The day after the Brexit decision sees the world's biggest democratic exercise get underway. Something like 900 million Indians will go to the polls over a 6-week period from April the 11th until May the 23rd. Voting will take place on 7 separate days to enable the polls to be conducted in a secure way. The consensus view is that incumbent Prime Minister Narendra Modi will probably win a second 5-year term, although the leader of the BJP party is by no means a shoo-in. His populist and nationalist rhetoric means that he is loved and loathed in equal measure in India. The upcoming election is in large part a referendum on Modi's first 5 years in office. Although Hindu identity politics will be a key determinant of the outcome, the economy is an important driver too. Modi was elected on a platform of economic reform and anti-corruption in 2014, so he needs to demonstrate that he has delivered. That won't be easy against a backdrop of high but slowing economic growth and rising unemployment. The jobless rate of 7.4% is the worst in 2 years, with the situation for women particularly poor. Participation by women in the workforce is very low at just 27%. With millions of young workers entering the workforce each year and a graduate unemployment rate of 15%, it's vital that India steps up the pace of job creation. There is, however, plenty of good news as well. GDP growth remains above 7%, that's faster than China and the envy of the developed world. Consumer spending is growing fast, and the country has a young, large and competitive workforce that should make it very attractive to overseas investors. 2/3 of the population is under the age of 35. Stock market investors have focused on this good news story alongside a general increase in risk appetite in emerging markets on the back of the Fed's change of tack. Foreign investors have been big supporters of the Bombay Exchange, with the highest inflows for 6 years in the first 3 months of the year. India has actually been a much better performing market over the years than its main emerging market rival in China. In the past 20 years, it's performed twice as well, albeit with a similar amount of volatility. Now, back in the US, attention shifts back again to corporate earnings at the end of the week. Earnings season kicks off again with the banks first out of the blocks as the numbers for the first 3 months of 2019 are assessed. After the sugar rush of Donald Trump's tax reforms and under pressure from the ongoing trade tensions with China, earnings are expected to fall back in the first 3 months of the year, with a modest decline in earnings per share on average for the largest companies. That compares with double-digit gains in 2018 and will test investors' appetite for America's relatively high valuations. Corporate earnings are under pressure from what looks like a synchronized downturn, according to a range of sentiment indicators and economic data across developed and emerging economies. Later this week, an update by the International Monetary Fund of its global forecasts is expected to signal another slowdown, with growth momentum, sentiment and hard data all turning lower. Meanwhile, oil continues to rise, hitting a 5-month high this morning as the Libyan conflict looks likely to escalate. Brent crude rose above $71 a barrel as investors worried that supplies would be hit by further fighting in Libya, having already been cut by OPEC-led supply cuts, sanctions against Venezuela and Iran, and hopes for a stronger global demand.